Mike Kasecamp is a certified plan fiduciary advisor and qualified 401(k) administrator. He is the president of CNB Wealth Advisors. He has spent 18 years in the financial services arena and specializes in institutional asset management, including foundations, endowments, and corporate retirement plans. He also served on the board of directors for the ARC of Washington County for the past 11 years, and SEK will be donating $500 to the ARC, that is Mike's nonprofit of choice, as a thank you to him for being here today. And for those who don't know, the ARC of Washington County, Maryland empowers youth and adults with intellectual and developmental disabilities through person-centered support that promotes inclusion, independence, and opportunity. So with that, I'm going to turn it over to Mike to kick things off for today.
Good morning, everybody. Thank you for the warm introduction, Aaron. Really excited to be kicking off the webinar here today and talking about something I'm very passionate about, and that is helping nonprofits invest and manage one of their most important resources through endowment and foundation management. Just a little background on me before we kick things off. As Aaron mentioned, I've been in the financial services industry for about 18 years. The first 12 were spent specifically managing institutional assets, so endowments, foundations, retirement plans, large pools of money. And then recently, I took over as president of the Trust and Wealth Services Division of CNB Bank. Um, Very proud supporter of a lot of local nonprofits through our organization. And of course, I've been serving on the board of the ARC of Washington County for the past 11 years, which has been a wonderful experience and look forward to many more years to come. So what we're going to be talking about today is really how we structure investment management from a nonprofit's perspective. What I'm hoping to leave everybody with today is a very good foundation for how you structure this, how you align your investment objectives with your mission of your organization, and what are the oversight provisions that are critical in order to to sponsor and maintain these types of programs. I know we have a diverse group on the that are attending today. We have board members, employees. So I'll try to touch on several different areas of oversight, but also from different perspectives of how we should be thinking about this from an organizational level. Um, so one of the main things that people think about when we're trying to figure out how we align our mission with investing is they don't want to sacrifice returns. So we're gonna dispel that myth a little bit and talk how we can achieve both of those outcomes, aligning our investments with our mission, but also achieving maximum returns and being able to use those critical resources for service programs and just supporting the mission in general. So here's what we're going to cover today. We're going to walk through, the way we set this up is trying to think about this as the natural arc of fiduciaries thinking. So where does the money come from? Where can it go? How our mission shapes the choice of what we're going to invest in, and then how our committees govern the process. We're going to hone in on really three sections here. Um, First being mission alignment. We're going to talk about some successful case studies that we've seen, both at a national and local scale, and then committee structure, which we think is critically important. If you have questions as we're going through, please put those in the question box. If it's on a topic that we're covering currently, we'll engage those as we go. Otherwise, we'll answer any that are outstanding as we get to the end here. So some of the case studies that we're going to touch on are from the Nature Conservancy, the Acumen Fund, and the Ford Foundation. And I'm going to give two examples of some local nonprofits that have done some really strategic but very cool things with their endowment proceeds as well. So as we go, please feel free to put your questions in the box and we'll get those answered either as we go or towards the end as well. All right. So why is this important right now? So, being at that, I've served on a nonprofit board, for the last decade. One of the things that I've noticed, not only from the board that I served on, but from other local nonprofits, is that they are facing, kind of a headwind in terms of rising operational costs, donor fatigue, increasing pressure from boards to make every dollar work, both financially and for the mission. So it's becoming more and more important to create these types of programs and then being able to support the mission on a long term um, as well. So let's talk a little bit about some of the different ways we can structure this. So endowments are one of the most popular ways that we see nonprofits set aside funds for long-term future growth of the organization. So an endowment is a pool of assets, could be unrestricted or restricted, whose principal is preserved while typically the earnings are spent. So what that means is, we'll put these dollars in a pooled investment. We'll invest those in a multitude of different ways. And most organizations use the earnings, somewhere between typically 4 and 5%, to fund things like new programs, new processes, hiring new people, or just reinvesting those dollars into the mission. Foundations are basically a separate legal entity that are created to give things out like grants, put money back into the community. So a little bit different structure, but in the investment principles for both of these are going to work very, very similar. One of the main differences is how the spending rules work. So what I'm hoping that everybody leaves with today is that you're able to describe your organization's investment policy in plain English, ask sharper questions of their advisors that you're currently working with, and then connect investment decisions back to their mission statement. Many nonprofits historically have underinvested or kept way too much money in cash, and that has an opportunity cost that is substantial over a 10 to 20 year period. So it's critically important to define what is your short-term cash needs, midterm goals, and then long-term investment opportunities, and really set up those three buckets so that we don't orient too much in cash or not fund the future enough as well. So let's talk a little bit about some of the funding sources that are available to nonprofits. So most of this will be, pretty straightforward. A lot of the funding sources we have here today are things that you live day in and day out in the nonprofit space. But what we should be able to take away from this is that each one of these streams behaves differently and therefore should be invested differently. So some of the funding mix that we typically see with nonprofits are government grants, private donations, corporate sponsorships, and endowment funds. Each of those has very unique characteristics and different requirements. Um, And then of those, grants typically are used to fund specific projects. So when you apply for a grant, it's usually for a very specific purpose. Gifts, typically in the form of donations, can come in as unrestricted or restricted, meaning that, if there's a restricted purpose, typically they have a specific um, investment goal or use that they're going to be used for. If they're unrestricted, it's really up to the organization for what they're going to be used for. And then, of course, endowments. Endowments are pooled assets that are going to be invested over a long period of term to generate additional income for the organization. So there's very critical cash management discipline that is needed when segregating these different funding mixes and then how they're going to be used for long-term investment. One thing with endowments is very critically important is creating an investment or excuse me, a spending policy. So just deciding how much of that pool we're going to be used on an annual basis to fund projects, to fund things for the mission of the organization, and how much of that is going to be coming off. The typical that we see is about 4 to 5%, but it can vary based on the organization, your goals, how much money is in the endowment, a couple different factors there. And then one of the big ones that we're going to talk about in a little bit more detail later in the presentation is community foundations. We are very lucky in our area that we have very, very strong community foundations, both in Maryland and West Virginia and Pennsylvania. And they are great resources, especially for smaller nonprofits that don't have the critical mass or the resources internally to be able to run an endowment pool or foundation, but they want to partner with somebody that does have that expertise and critical mass. We'll talk a little bit about those, how they work, and some of the great work we've seen done through community foundations in our community. And then um, one of the most critical points of each one of these different funding sources is that we shouldn't have an investment policy that applies to all of them. Each of these have their own goals and objectives. So we should have investment policies really across these different frameworks to make sure it aligns not only with our mission, but also what are the either the short, midterm, or long-term goals of each one of those buckets that we're going to be pulling from. So when we're setting up an endowment, one of the most critical things that we do first is select appropriate investments for nonprofits. So this is both from an asset class risk management and time horizon point of view, but also making sure that that aligns with the mission of the organization. So we'll talk a little bit about that more in detail after we talk about the appropriateness of investments. Time horizon is, one of those most critical things in terms of whether it's short-term cash needs, midterm um, objectives, or long-term planning for the organization. So that is a critical component when we're trying to figure out what type of investments we're going to use, whether it be, short-term where we're more cash oriented, midterm where we don't want a lot of risk, or long-term growth where we're trying to outpace inflation and provide income to the organization. And to do that, we're going to use several different asset classes to achieve those goals. Most endowments are set up with a diverse mix of equities, fixed income, real estate, and alternatives. And each of those have a very distinct risk and return profile to match different time horizons or overall investment objectives. So equities, which are basically stocks, those are the long-term growth engines that we put into our investment portfolios. They're there for maximizing growth and also for inflation protection. Your fixed income portion, which is typically bonds, those are going to provide stability as well as liquidity and income for the organization. And then real estate is one that offers diversification to your stock and bond portfolio. Alternatives are something that's becoming more popular within endowment strategies. They consist of things like private equity, hedge funds, non-traditional real estate assets, and can offer returns above what you typically see in your more common stock and bond portfolios. I will say that using alternatives for smaller endowments usually does not make a lot of sense. They're complex, typically illiquid, can have higher fees. So most nonprofits that have less than $50 million in assets typically should to stay away from alternatives. But we are seeing some unique offerings that are more appropriate for smaller organizations as well. Those should just be vetted very carefully, be defined in your investment policy statement as to how and when they're used, and making sure you have really good committee members that can oversee that process in addition to any financial professionals that you have. Risk management is not just about managing volatility. It's also about managing liquidity risk. Being able to use these funds if the organization gets into any type of trouble. Worrying about things like concentration risk. Um, do you have too much exposure in any different sector that create negative outcomes for the portfolio? And then also reputational risk is something that a lot of people don't think about. Are any of your holdings working against your mission or going to in any way embarrass the organization in the community? So those are all risk management components that need to be looked at when you're structuring or building this. Time horizon is one of those things that is very critical, and then a lot of committees actually get wrong sometimes. They invest their endowment, as if they're going to use the funds in the next 1 to 3 years rather than it being set up in perpetuity. Most endowments are structured to last forever. So we don't want to invest those like we're going to use all the funds in the next 1 to 5 years. So it's critical to set up your short-term cash buckets, mid-term cash buckets, and then your long-term oriented investments, and then apply those appropriately. Simple way to think about this, uh, leave funds in cash or money market instruments that you're going to use in the next 2 years. Your midterm goals are a mix of your cash or cash alternatives as well as fixed income. If you have basically like a 3 to 5 year time horizon. And then anything that has a longer than 5 year time horizon is more appropriate for growth oriented investments. So equities, high yield bonds, alternatives potentially. Those are all good fits for your longer term assets. So one of the great questions you can ask, your financial advisors or your committee is when is the last time we updated our asset allocation policy? And then does it align with how we have our current pools of money set up? Most have not reviewed this in a long time, so it's very critical that this gets reviewed, typically every 2 to 3 years to make sure it still aligns with your objectives, your cash needs, and then the overall organizational goals. One of the main drivers of investing in line with your mission is making sure that if you're an organization that has a very specific purpose, that you're not investing anything in that goes against that purpose. So, one of the things that you want to look at when you're structuring this is if you are a conservation nonprofit, as an example, you want to make sure that you're not overweight or using too much in things like fossil fuel related investments. Think about companies like BP or ExxonMobil. It very much goes against uh, the really the purpose of the organization. So taking a look at your underlying investments is very critical. You want to make sure that they're not working against what your overall mission is. So if you're a healthcare focused, foundation or organization, it's not a good look to your donors if you're also invested in uh, things like big tobacco or fossil fuels or things that can drive negative health outcomes for that organization. Or if you're a faith-based organization, you don't want to be investing in items that go against, the uh, goals and purpose of that organization as well. It's becoming harder to really understand what are your underlying investments because a lot of endowments and foundations use mutual funds, which are pooled assets that own hundreds, typically of stocks and individual companies inside of those mutual funds. But the screening tools that are now available help with that. You can actually indicate in your screening tools things that you do not want in your portfolio or you do not want to be overweight in your portfolio. And that can really help basically get rid of anything that works against your organization or you don't feel that you should be invested in. ESG integration considerations, things like sustainability factors alongside traditional financial analysis. So that's a pretty critical component to this as well. And then impact investing. So that's where you're actively seeking investments that produce measurable social or environmental outcomes. Um, there are many different tools out there that are available to help with this structure. And I think one of the most critical things is defining this in your investment policy and then reassuring on an annual basis that you're, meeting those goals and meeting those objectives through those screening tools. If you're working with a financial advisor, they're typically very good at this working with nonprofits. You can really define what the mission of the organization is and things that do not align with the mission in your investment policy statement, and then screen those investments out from the get-go. One of the last things that you want is for your donors to go and pull your 990 and look at your investment portfolio, and let's say you're working for a conservancy organization like Oceana. One of the biggest things that they're trying to do is protect the oceans of the world. It would look very bad to their donors if they're heavily invested in plastics companies like Coca-Cola or Pepsi. They're one of the biggest pollutants of those types of facilities, and that could turn donors off from giving you money if you're going to use it in investment strategies that don't align with what you're trying to work against. So there are many different tools out there. There's great resources available that you can actively screen out these things. And it's important to go back and look at this if you haven't done this already to make sure there's nothing in your current portfolios that is working against what your overall mission of the organization is. Let's talk a few minutes about some of the case studies that are out there. Um, these are the more national ones that really provide good framework. And then these are also very highly researched case studies that you can go out and kind of dig into a little bit further to see what they're doing, how they've structured them, how they've built them up over the last few years, and why they are good things to try to model for smaller organizations that don't have the scale of some of these, but you can repeat a lot of these processes at a lower level. So the first is the Nature Conservancy. They created what was called the NatureVest platform, which channeled investor capital into sustainable land use, water conservation, and renewable energy projects. So essentially, they pulled assets uh, to align with their mission and then put those dollars to work to achieve those goals. We've seen this be very successful, even with smaller nonprofits, where they were able to pull some of their endowment assets and create new programs within the organization using the income from their endowment assets. And we'll talk a little bit about those as well. So the main lesson from the Nature Conservancy is, a mission-aligned investment can produce both conservation outcomes and competitive financial returns. So this is very useful for organizations whose mission naturally maps to a real asset thesis. The Acumen Fund, they treated philanthropy as a patient capital. So what they did is invest in early stage enterprises serving low income markets. So they provided capital to businesses and low income communities, particularly in healthcare and education, because what they found was in those types of communities, if they had the critical infrastructure in healthcare and education, it was one of the best ways to lift those communities out of that low income environment. We see this day in and day out in the financial advisory world. The more education and the better the healthcare, typically the higher earning potential for those individuals. And that was really the basis for the Acumen Fund. So another really great real world program that used pooled assets to invest back in their local community to kind of lift those folks out of some of those lower income environments. The third is the Ford Foundation. This one is interesting because of who set it up and then what the overall goals are and then what they decided to do as a foundation. So under Darren Walker's leadership, they committed $1 billion of its $16 billion endowment to mission-related investing. And one of the first things they did was divest from fossil fuel exploration. Um, so the lesson with this one is, even century-old institutions can rewrite their investment policy, when their board commits to it. And then the other thing the Ford case also illustrates is that divestment alone is not a strategy. So just getting out of fossil fuel exploration is not the strategy. The redeployment of that capital is what is really critical. Um, so most nonprofits in this room, don't have a $16 billion endowment, but everybody in this room can take concrete steps to adding a single mission aligned manager. So, screening out one objectionable sector, one objectionable investment, or carving out 5% of your overall portfolio for local impact investments. Those are things that you can get started on now that are going to pay significant dividends over the next decade, even though you're starting out small and then continuing to grow that. So what we recommend is start small, document the policy, measure those results, and then commit to that over a longer period of time. Community foundations are one of those critical resources that are available, especially in our area. So community foundations are basically organizations that pull assets and then typically are grant makers for the community. So, they'll pull capital from local organizations and then they'll match those opportunities to expand what that organization can fund. The really big benefit with them is they have the professional investment management, due diligence, and grant making capacity, where a lot of smaller nonprofits do not. So if you're an up and coming nonprofit or one that's been established but it doesn't have the critical infrastructure or capital yet, community foundations are a great resource you can go to. You can set up your endowment directly through them, even with a small amount of money. The fees are typically lower than what you would see as a standalone basis, and they're great champions of getting those pooled assets back into the community through projects, partnerships, grants. They're very good collaborators at the community level. So we highly encourage, especially the smaller nonprofits, to look into those and see if they would be a good fit for your organization as well. So some of the great things we've seen out of community foundations locally, health initiatives is a big one. We've seen a lot of great partnerships locally that have set up health campaigns, whether it be screening for preventable diseases, getting access to healthcare for lower income or marginalized communities. That has been a big push here locally in really the tri-state area, Pennsylvania, Maryland, and West Virginia. Educational programs, another great one. We've seen partnerships through scholarships, grants, putting in after school programs. These are all great initiatives that we've seen through community foundations that are funded typically from pooled resources of local nonprofits. And then another is environmental conservation. We've seen a lot of efforts around that. One of the great things about the communities we live in is that we have a very great mix of urban, but also outdoor recreational areas, and preserving that is a great benefit to our community, and it's a big important process to those community foundations and a lot of the nonprofits in this area. All right, so let's talk a little bit about investment strategies once you're able to set up an endowment or foundation. So what we've put together here is just a sample, what we call a more standard mix of investments. Looking at our donut chart here, typical asset allocation that we see for setting up an endowment is about 55 to 60% of that portfolio in stocks or equities, about 30% in bonds or fixed income, up to potentially 10% in alternatives, and then leaving about 5% in cash or cash equivalents. So that's your CDs, treasuries, money market funds type of investment approach. So this is going to be very tailored and catered based on the organizational goals, time horizon, risk metrics, a number of different factors. But this is a very common investment structure that we see. We don't want to go too heavy any direction, one way or the other, because we want to be able to achieve the long-term goals of the portfolio, which will be growth, and then be able to use the income to reinvest back into your organization. A big part of this is diversifying the portfolio, aligning your asset allocation based on time horizon, risk tolerance, goals of the organization, and then critically important, monitoring this usually on a quarterly basis and rebalancing where appropriate, and then updating your investment policy statement depending on your goals, things that change within the organization. Um, those are your kind of your critical components when you're thinking about how to set up the investment strategy and the overall asset allocation. So then the question becomes, how do we measure this? Um, and this sometimes becomes tricky, especially if you're trying to maximize growth, but also align with your mission, where you might be carving out some things that may help you outperform whatever benchmark that you set up. So we'll talk a little bit about what can your KPIs be, your key performance indicators? How do you look at ROI? And then how do you create a feedback loop to your board or your stakeholders, showing what the committee is doing, how you're monitoring it, and then what the overall performance is. So what we like to do is build out a four-part performance framework that most investment committees should be using. So you should be looking at absolute return. So basically, did we make money? Relative return. So did we beat whatever benchmark that we're working against? We should be looking at risk-adjusted return. And what that measures is whether you're taking too much risk compared to your overall asset allocation. And then, of course, your return net of fees, we think is very important to look at. Fees are one of the things that can be one of the biggest drags on overall investment performance. So we want to make sure we're monitoring that. So having those at least those four critical components as your initial KPIs is a really good starting point. And then from there, you can build on different frameworks to help review and monitor that. So one of the key things to do here is just pick your key financial metrics that you're going to be looking at, get a good starting point. Those four that we mentioned are a great starting point, and then building out the overall objective from there. And then the next most critical thing is creating a very transparent feedback loop to your board. How are you reviewing this? What are you looking at from a KPI point of view? Um, are you achieving the goals that you're setting out, both in your investment policy statement and the overall goals of the portfolio? And then being very honest about how that has been performing. Don't shy away from when things underperform, when you need to look at or evaluate replacing or coming up with a different structure. Those are all critical components when you're looking at how you structure and measure this. And that leads directly into how we structure an effective investment committee. I think this is one of the most critical components of this. Um, Looking at your composition of the committee, what are the roles and responsibilities, and then what is your engagement and communication? So to us, composition is absolutely critical. You want really a diverse group of your board, community representatives, financial experts, employees within the organization, Typically, you want to set that somewhere between 5 and 9 people. We like to use an odd number so that it works better for voting. Um, 5 is typically the minimum we recommend because less than that, you typically don't get the diverse uh, perspectives that you're looking for. And then larger than 9 just becomes, a bit of a headache in terms of pulling people together. And you might get very, very differing perspectives with that large of a group. So 5 to 9 tends to be the sweet spot um, to set that up. And then defining what the roles and responsibilities of those individuals are is very critical. So, who's going to be the chair of the committee? What is going to be their role? Are you going to take direction directly from your financial professional, or is it going to be more governed by the committee? And then how do you engage and communicate that regularly? So, best thing you can do is have regular meetings, update your board on a regular basis, provide education sessions, put it in your annual report if you're distributing that to the community. It's critical to us to be as transparent and as forward-looking as you possibly can. So that way it looks like you really have a sound process in terms of managing these dollars that people are entrusting to you. All right. So let's talk about some of the future trends in nonprofit investing. Biggest thing that we're seeing right now is impact investing. So what the best way I can describe this is really more non-traditional investments. So this is investing in things locally like real estate projects, services that are critical to the community that your organization provides. These are things that are going to generate returns. So typically real estate, there's asset appreciation and income coming in potentially. Services that you're providing to the community are typically revenue generating, can be looked at from an investment point of view. And we've seen great success with some local organizations that have done this. The Arc of Washington County has done a very good job um, with part of their mission investing in housing for their residents. So we've seen that be very successful. Hospice of the Panhandle used portion of their endowment to create additional services to the community that were critical for hospice care. So you can look at this not only as investing in stocks, bonds, and alternative assets, you can invest in real assets that are going to benefit directly to the community. So we've seen a big uptick in this. And you can measure this just like you measure, stock and bond returns. Sustainable and responsible investing, SRI investing, we've seen a big uptick in. That helps you align kind of your overall goals with the mission of the organization. So we've seen a lot of really good processes put into place in your investment policy to really outline what this is going to look like. And then, of course, technology integration. You can't go anywhere without hearing about AI at this point. And we're leveraging it now more than ever in terms of investment structure and ways to be looking at, or I should say, alternative ways to be looking at, the best way to get bang for your buck on your pooled assets. So integrating technology into what you're doing on a daily basis will really help outperform what your benchmarks are, and then also give you ideas for future deployment of capital that can help not only grow your endowment fund, but create additional income that can be used for a multitude of different things. And one of the creative things that we did with the ARC is we started using some of the income from the endowment to create deferred compensation plans for some of the senior leaders and program leaders of the organization. That really helped with employee retention. So there are a lot of really creative things that you can do with endowment dollars nowadays that will help not only the organization, but the community that it serves, and also your employees of the organization as well. All right, so we're getting close to the end of our time slot here. So just want to bring the conversation full circle. Really the primary goal or the primary thesis of today is creating an investment strategy, um, you know, in mission that are not parallel tracks. You want them to be on the same track. So we want to look at the viewpoint that strategic investing is no longer optional. We think it's required. Endowments that grow modestly above inflation over decades create the financial flexibility that lets nonprofits weather recessions, pursue ambitious programs, and ultimately serve more people. Uh, Best practices for these organizations, think about the three foundational habits that we covered: alignment, diversification, and partnership. We think those are all critical to be looking at. And then looking ahead, how can we incorporate impact investing into what we're doing? How can we look at ESG and SRI as criteria that we're looking at? And then how can we incorporate better technology and resources into what we're doing that are really going to enhance and provide more value to the organization? And that is wraps up our presentation for this morning.